There is an old saying in the world of high finance. It goes, profit is an opinion, cash is a fact.
Right.
It's catchy, right? I mean, it makes you feel like if you just look at the bank account, you know the absolute truth.
It is a classic. But in the modern world, I think we really need to add a third line to that proverb.
Oh, yeah. What's that?
What it should be, profit is an opinion, cash is a fact, and the balance sheet. The balance sheet is a battlefield.
I love that. And that is exactly where we are marching today. Welcome back to the deep dive. Usually, we are zooming out, looking at global market trends, AI revolutions, the big picture stuff. But today, we are doing the exact opposite. We are looking under the hood of the corporate vehicle. We are climbing right into the engine room of financial reporting.
We really are. And honestly, for anyone listening who cares about how a company actually works, how it finances its growth, how much debt it's really carrying, this is one of the most significant engine overhauls we have seen in the last 20 years.
We are talking about Ind AS 116 leases?
The standard that changed everything.
Now, hold on. I can hear some of you reaching for the skip button right now. You're thinking, leases. I would rather watch paint dry.
Yeah, it sounds a bit dry at first.
Right. But let me stop you right there, because this isn't just about renting a photocopier or paying for a WeWork office. This is about billions, literally billions of dollars of debt that used to be totally invisible suddenly appearing on corporate books overnight.
Exactly.
This is about the death of the off-balance sheet magic trick.
That is the perfect way to frame it. It is a massive move from a world of opacity to a world of radical transparency. Under the old standard Ind AS 17, we had this very binary, almost gameable system.
Right.
You had finance leases and you had operating leases.
And the game was pretty simple, wasn't it? If you were an airline or a retailer or a logistics company, you wanted everything to be an operating lease.
Oh, absolutely. Because an operating lease didn't look like debt. It was just a footnote. You could lease 100 airplanes worth billions of dollars, and on your balance sheet, your debt was zero. It was just a rental expense in the P&L every month.
Yeah.
It was the ultimate off-balance sheet financing.
And then Ind AS 116 came along and basically burned that playbook to the ground.
It did. It introduced the right-of-use model. The standard setters basically said, we don't care what you call it in the contract. We don't care if you call it a service agreement or a rental.
Doesn't matter.
Right. If you control the asset and you have the right to use it, that is an asset. And if you have an obligation to pay for it, that is a liability, period.
So our mission today is to move past the headlines. Most people in the industry know leases are on the balance sheet now. That's old news.
Right.
We are going to get into the mechanics, the messy, gritty details from our source materials. Because as we dug into the specific illustrations for this deep dive, we realized that the devil isn't just in the details.
No.
The debt is in the details.
It really is.
Yeah.
A tiny clause in a contract, like a floor in a rent increase or a renovation clause in year 3, can swing a company's reported liabilities by millions of dollars.
So we're going to act as the learner today. We have a stack of illustrations from the source material. We're going to be looking specifically at illustrations 16 through 18, 20 through 22, and the famous test your knowledge 7 scenario.
A lot of ground to cover.
We are going to tear them apart. We are going to analyze what actually counts as a payment, when does the timeline change, and how do we handle the interest rates?
It sounds super technical, but it's actually deeply strategic. Let's get into the weeds.
Okay, let's start at ground zero. Section 1, the liability. You are a CFO. You sign a lease for a massive warehouse. You know you have to put a number on the board labeled lease liability.
Right.
But a lease isn't just a sticky note that says pay $100. It is a 50-page document.
Oh.
It has insurance, maintenance, inflation adjustments, penalties, renewal options.
It is a very messy bucket of obligations.
So what actually goes into the calculator? When we are determining that initial liability number, what ingredients are we allowed or forced to include? Let's start with illustration 16 from our sources.
Okay, so illustration 16 is our baseline. The standard is very specific here because it has to be. It is trying to isolate the financing portion of the relationship.
Okay.
The liability is made up of 5 specific ingredients. First and most obviously, your fixed payments.
The rent check.
The rent check.
Yeah.
But critically, minus any lease incentives. So illustration 16 really highlights this. If the landlord says, sign for 10 years and I'll give you the first 6 months free, you factor that deduction in right away.
Right.
You look at the net fixed cash flow over the term. You don't just blindly multiply the monthly rent by the number of months.
Okay, that's the easy part. Just map out the actual cash leaving the building. What's next?
Second, you have variable payments. But And this is probably the most critical distinction in the entire standard, only those that depend on an index or a rate.
Yeah.
This brings us right to illustration 17.
Ah, okay. Variable payments linked to an index.
Right. Like the Consumer Price Index or CPI,
Yeah.
or a benchmark interest rate like SOFR.
So illustration 17 deals with this.
Exactly. In illustration 17, a company has a lease where the rent goes up every year based on the CPI.
Oh, okay.
So the question is, how do you calculate a liability today for a payment that will change next year based on inflation we don't know yet?
Yeah, do you have to hire an economist to forecast inflation for the next 10 years?
No, thankfully, the standard setter didn't want companies making wild guesses. You just use the index rate as it exists on the commencement date.
Yeah.
If CPI is at 100 today, you project the payments assuming it stays exactly there.
So you don't build in future inflation.
No, you don't.
Yeah.
You only update the liability later when the cash flows actually change because the index officially changes. But the key is those index-linked payments do go into the initial liability bucket.
But what if your contract says rent goes up if you sell more T-shirts?
That is illustration 18, pure variable payments based on performance or usage. And those do not go into the liability bucket.
That is a massive distinction. We need to circle back to that because that feels like a massive strategic lever. But let's finish the list first. We have fixed payments and index-linked variables.
Okay, third ingredient. The exercise price of purchase options. But only if you are reasonably certain to buy the asset. If it's just a vague possibility, you leave it out.
Makes sense.
Forced termination penalties. Again, only if the lease term reflects you exercising an option to leave early. And finally, residual value guarantees, which is perfectly laid out in illustration 20.
Let's pause on illustration 20 for a second. What is a residual value guarantee?
So imagine you lease a fleet of delivery trucks for 5 years.
Okay.
The leasing company says, we are going to sell these trucks when you give them back in 5 years. We need to know they'll be worth at least $10,000 each. If the market value drops below $10,000, you have to pay us the difference.
Wow. Okay. So I am guaranteeing their future resale value.
Exactly. You are taking on the asset risk. So under illustration 20, you have to estimate the amount you expect to pay out under that guarantee.
So if I expect the trucks to be driven into the ground and only be worth $6,000 each pound,
Then you expect to be on the hook for $4,000 per truck.
and that $4,000 goes into my lease liability today.
Exactly. It gets discounted and added to your balance sheet debt on day one.
Okay, so that's the laundry list. Fixed payments minus incentives, index-linked variables, purchase options, penalties, and expected residual value guarantees.
That's the core bucket.
But I want to zoom in on that first one again, fixed payments.
Sure.
Because the source material spends a lot of time on this concept of in-substance fixed payments. That sounds like heavy accounting jargon for, it looks like a duck, but you're trying to call it a rock.
It is. It's essentially the anti-abuse provision of the standard.
Explain that. Why do we need an anti-abuse provision for fixed payments?
Well, think about the incentive.
Mm-hmm.
We just said that variable payments based on performance, like illustration 18, do not go on the balance sheet. They're just expenses.
Right.
So if you are a company that wants to hide debt, what do?
I try to make my fixed rent look variable. I tell the landlord, hey, don't charge me $10,000 a month. Charge me something else that looks like it fluctuates.
Exactly. You try to disguise the payment. So Ind AS 116 introduced this concept of in-substance fixed payments. These are payments that might look variable in the contract. They might have a complex formula. But when you look at the economic reality, they're completely unavoidable.
There is no genuine variability.
None. Let's make this concrete. This brings us to another great example from the underlying concepts, which often gets debated, the real estate taxes scenario.
Oh, yes. I think this trips a lot of people up because we are trained to think of taxes as totally separate from rent.
It is a classic trap. So let's set the scene. An entity enters a 10-year lease for an office building. The contract is very clear. The fixed annual rent is stated as $170,000.
Okay, $170,000. That definitely goes in the liability calculator.
Right. But then there's a separate line item in the contract. It says the tenant must pay an additional $30,000 per year for real estate taxes.
So the total check the company writes every year is $200,000.
Correct. Now put your business owner hat on. You look at that $30,000 in tax payment. What is your gut reaction? Is that rent? Or is that just a tax?
My gut says it's a tax. Taxes change. The local government sets the tax rate, not the landlord. Maybe they lower taxes next year. It feels variable. It feels like an administrative pass-through.
That is the intuitive reaction.
Right.
You want to treat it as a variable administrative expense.
Yeah.
Expense it as you pay it and keep it off the balance sheet liability.
Right.
But the standard asks a deeper, more structural question. Does paying that tax provide you with a separate good or service?
Meaning, does the landlord come and paint the walls for that $30,000?
Exactly. Or do you get security services?
No.
Or a front desk concierge?
Mm.
Or utilities?
Yeah.
In this case, the answer is no.
No. I'm literally just paying the landlord's property tax bill.
Precisely. You are reimbursing the lessor for the fundamental cost of owning the building. That tax is an inherent cost of the property. By paying it, you aren't getting anything extra. You're just paying for the right to use the space.
I see.
Therefore, the standard views that $30,000 as essentially just more rent disguised as a tax reimbursement.
So it is an in-substance fixed payment.
It is. Even if the tax amount changes slightly year to year, the obligation to pay it is fixed. It is completely unavoidable. You cannot occupy that building without covering that cost.
So when I'm calculating my debt, my lease liability, I don't discount the $170,000. I discount the full $200,000.
You discount the full $200,000, you capitalize the tax.
That is a massive takeaway for anyone reading a contract right now. Just because it's labeled reimbursement or levy doesn't mean it's not lease liability. If it doesn't give you a separate, distinct service, it is likely rent.
Exactly. But let's ramp up the complexity. That tax one is fairly binary once you understand the rule. Let's look at illustration 21, the floor clause.
Oh, the floor clause. I feel like every commercial lease has one of these in it.
It is a very common negotiation tactic, especially in retail and commercial real estate. But under Ind AS 116, it has a massive side effect.
Walk us through the scenario in illustration 21.
Okay, so entity P leases retail space. The base rent is set at $1 lakh, that's $100,000 per month. But landlords love upside. They want to participate if your business does well, and they want protection against their own costs rising.
Sure, standard practice, rent always goes up.
But the formula for the increase is the twist here. The contract says the rent increases every year by the greater of two options. Option A is 1% of the entity's sales revenue.
Okay, pause there. Let's look at option A. 1% of sales is totally performance-based. If I sell absolutely nothing, 1% of nothing is nothing.
Right. It is fully variable, just like we talked about with the illustration 18.
And option B.
Option B is 2% of the previous rental rate.
So that is a fixed percentage hike. It's a floor.
It's a hard floor. So now imagine you are the accountant. It's day one. You have to book a liability for the next 10 years. You have to predict your payments. What numbers do you put in the financial model? Do you guess what the sales will be?
Well, if I am the CEO, I am definitely optimistic. I think my sales are going to be huge. I fully assume I will end up paying the 1% because it'll be way higher than the 2%. So shouldn't I include that expected payment?
The standard says absolutely not. And this is where people really get confused. The 1% of sales is pure variability. We do not know if you will sell anything. That part is truly unknown. It creates no guaranteed debt on day one.
So I just wipe the sales forecast from my mind entirely.
Or the liability calculation. Yes, you wipe it completely. But look at the 2% option. Is there any scenario, any world in which you do not pay at least that 2% increase?
No. Even if another pandemic hits and I sell 0 t-shirts,
Yeah.
effectively, the contract says I owe that 2% increase. That is the absolute minimum.
Precisely. That 2% increase is unavoidable. It is in substance fixed. So when you build your amortization schedule for the lease liability, you must assume the rent increases by 2% every single year.
Wow.
You bake that growth into the liability immediately at day one.
That is fascinating. So the standard essentially forces you to look at the absolute worst case scenario of your cash outflows. It's asking, what is the minimum amount of money you are legally forced to part with?
That is the perfect way to frame it. The balance sheet liability is the inescapable debt. It is not a forecast of what you will pay. It's a hard calculation of what you must pay.
And what happens if my sales actually do go through the roof? Say in year 3, 1% of my sales is $100,000 and the 2% floor was only going to be $2,000. I have to write a massive check to the landlord.
Then you write the bigger check. But that extra amount, the difference between the floor you planned for and the actual sales percentage that hits your profit and loss statement as a variable rent expense in that specific year.
It just flows through the P&L.
Exactly. It never touches the balance sheet lease liability.
This creates a really interesting incentive structure. If I am a CFO and I am obsessed with keeping my leverage ratios low,
Yeah.
I want my debt to equity to look really pretty for the board and investors, I have a massive incentive to negotiate contracts with super low minimums and high variable
You
rates.
absolutely do. This is the strategic game being played in real estate right now. If you can convince a landlord to accept a lease with a tiny base rent and a huge percentage of sales, you effectively hide the asset's cost from your balance sheet
Oh,
liabilities.
it's pure variable.
Exactly. Let's look at illustration 22 because it takes this strategy to the extreme, the production line case. This one really clarifies the massive difference between business reality and accounting reality.
Right. Let's dig into illustration 22.
So Company N leases a production line, a big, massive manufacturing setup. The terms are very interesting. They pay 1,000s per hour of use.
Okay, that sounds like pure variable. If I don't run the machine, I don't pay.
If that were the only term, you would be entirely right. It would be completely off balance sheet. But of course, the landlord isn't going to let you hold a $1 million machine in your factory for free.
No landlord's that nice.
Right. So there's a catch. There's a minimum annual payment of 10 lakhs. That's 1 million.
Ah, the minimum guarantee. The safety net for the lesser.
Now here is the context. Company N creates its business plan for the year. They expect to be incredibly busy. They expect to use the machine for 1,500 hours a year. At 1,000 per hour, that means they expect to pay 15 lakhs.
So the business reality, the cash flow they're actually budgeting for in their internal FP&A meetings is 15 lakhs.
Correct. But for the accounting reality, the Ind AS 116 liability, we go back to your inescapable debt rule. What is absolutely unavoidable?
Just the 10 lakhs, the minimum.
Just the 10 lakhs. So you capitalize the 10 lakhs as the lease liability. That is the debt you report to the bank.
And the other 5 lakhs. The money they fully expect to pay because they plan to run the factory at full capacity.
That 5 lakhs is based on usage, those extra 500 hours. That is considered pure variable. It stays completely off the balance sheet and hits the P&L as an operating expense only when the machine actually runs.
This is a huge distinction. I mean, think about the discrepancy here. You have a company that fully expects to pay 15 lakhs out the door, but the balance sheet only shows a liability for 10.
It is a big gap.
Yeah.
And it highlights that Ind AS 116 is not a forecasting tool. It is a measurement of legal obligation. You are not obligated to run the machine for those extra 500 hours. You choose to run it because it makes you money.
Right.
Therefore, the cost of that choice is an operational expense, not a structured financial liability.
That's a philosophical distinction that I think a lot of non-accountants really miss. Liability equals obligation. Expense equals choice.
Exactly. It's a great way to summarize it.
Before we move off payments, I want to touch on one more nuance mentioned in the source material regarding bridging the gap between lease and non-lease components, the water charges example.
Yes, this is important. We talked about real estate tax earlier. But often, a lease comes with other stuff bundled in. Utilities, maintenance, administrative fees.
CAM charges, common area maintenance.
Right. The standard generally allows you, or rather requires you, to separate these. You capitalize the lease portion, like the building itself, and you expense the service portion, like the cleaning crew.
But the standard also offers a practical expedient, right?
Yes, it does.
Translation for the learner. What is a practical expedient?
Basically, the standard setter says, look, splitting out the exact cost of the security guard versus the lobby square footage is really hard math. If you want, you can just bundle it all together and treat the whole single payment as a lease.
Okay, that usually simplifies things. It means everything goes on the balance sheet, which inflates your debt, but it saves your accounting team a massive headache.
Normally, yes. But the source material notes a specific exception with things like water charges. If the water charge is based on usage, meaning pay for what you consume, it is a variable payment. And the rule for variable payments, specifically those not based on an index or rate, overrides everything else.
So variability trumps the bundling election.
Exactly. Even if you elect to bundle your lease and non-lease components, if a specific payment is based purely on usage, like the amount of water consumed, it is variable. It stays off the balance sheet. Variability is the ultimate filter.
Okay, so we have rigorously defined what is payment. It's the unavoidable stuff, the fixed stuff, the floors, the in-substance fixed taxes. Now we need to figure out the second variable in the equation. How long are we actually paying it?
Section 2, the timeline, the lease term.
This sounds simple enough. I signed a 5-year lease. The term is 5 years. Let's move to the next topic.
I wish. Nothing in Ind AS 116 is ever that simple.
Fair enough.
The lease term isn't just what is written in bold letters on the cover of the contract. It is the non-cancelable period plus rent-free periods plus option periods.
Plus option period.
If.
What?
If the lessee is reasonably certain to exercise that option.
Reasonably certain. That sounds incredibly subjective. I mean, probable is a math word. Statisticians use probable.
Right.
Possible is a legal word. Reasonably certain sounds like a vibe.
It is definitely a judgment call, but it's a judgment call with teeth. It has to be backed by hard economic incentives. The standard asks a very pragmatic question. Do you have a significant economic reason to stay in that asset?
Give me some examples. What makes a company reasonably certain to renew a lease 5 years before it actually expires?
Okay, imagine you lease a massive warehouse for 5 years with an option to renew for another 5.
Got it.
In year 1, right after you sign up, you spend $2 million installing highly specialized robotic sorting systems into that specific building. Bolts drilled into the floor, custom conveyor belts, the works. It is totally tailored to that specific square footage.
That's a massive sunk cost.
Right. Now ask yourself, are you going to walk away after 5 years?
And just leave my robots. Or pay another $2 million to rip them all out and reinstall them somewhere else. No way. The cost of moving would be astronomical.
Exactly. The leasehold improvements, that renovation, create a massive, significant economic incentive to stay. Therefore, you are reasonably certain to renew.
Wow.
So for accounting purposes, that is not a 5-year lease. It is a 10-year lease. You have to book the liability for all 10 years right now on day 1.
So spending cash on a renovation essentially increases my reported debt because it forces me to extend my lease term calculation.
Correct. It locks you in economically, so the accounting reflects that lock-in. Other factors can be the importance of the asset to your operations. Is it your global corporate headquarters? Is it a specialized manufacturing plant where literally no alternative location exists within 500 miles?
Yeah, you can't just move a semiconductor fab.
Exactly. Or maybe the renewal rent is a total bargain and significantly below market rates. All these things make it reasonably certain you will stay.
Now, this brings us to one of the most interesting case studies in the source material. The Test Your Knowledge 7 scenario involving Retailer M.
Ah, yes, Retailer M.
This is all about triggers. Because you calculate the term on day 1, but you don't just set it and forget it, do you?
No, the balance sheet is a living, breathing thing. You have to monitor it constantly. The standard says you must reassess the lease term if a significant event occurs that is within your control.
So walk us through TYK 7, the Retailer M case. This really feels like a story about corporate strategy colliding head-on with accounting.
It absolutely is. So Retailer M leases a store. Let's say it's on the 4th floor of a big commercial shopping mall. The lease has a renewal option. Originally on day 1, they looked at it and decided, we aren't reasonably certain to renew. Maybe the location was risky. Maybe they were just testing the local market.
Makes total sense. Keep the liability low. Good conservative accounting.
So they book it as a short lease, say 3 years. But then at the end of year 3, a significant business decision happens. Retailer M acquires a new company. A competitor, maybe?
Okay, standard M&A activity. The business is growing.
Right. And they need office space for all the new staff coming in from that acquisition.
Yeah.
So Retailer M decides to lease another floor, let's say the 5th floor, in the exact same building to house this new team.
Okay.
And for this new floor, they sign a fresh 7-year lease.
So just to recap the board, now they have the old floor 4, with the uncertain renewal coming up, and a brand new floor 5, locked in for 7 hard years.
Right. And here is where the significant business decision trigger kicks in. The auditor looks at this whole picture and asks, does it make any operational sense to have half your staff on floor 5 for 7 years, but close floor 4 in a few months and move the other half of the company somewhere across town?
No. You want your teams together. The logistics of splitting them up would be a total nightmare. Synergies, culture, shared IT resources. It all points to staying put.
Exactly. The strategic decision to lease the 2nd floor creates a brand new significant economic incentive to renew the 1st floor. It makes it reasonably certain they will extend the original lease just to align with the new one.
So because they signed the new lease for the new floor, they have to go back and change the old lease accounting.
Yes. They have to open up the books for the original floor 4 lease at the end of year 3 and say, oops, this is no longer a short lease. We are staying. They have to extend the lease term and the calculation, which means adding all those future years of payments to the liability.
So the liability on the balance sheet just violently jumps up in year 3.
Significantly. And this matters immensely because it shows how operational decisions like, hey, let's buy this competitor, ripple directly into accounting decisions for legacy assets. You cannot view these contracts in isolation anymore.
That is a crucial takeaway. The accounting department needs to know exactly what the strategy department is doing. If strategy buys a company, accounting needs to know that it might trigger a lease reassessment on a building 3 states away.
Absolutely. The silo effect is the absolute enemy of Ind AS 116 compliance. If your real estate team is out there signing deals without telling the technical accounting team, you are going to have a massive restatement problem at audit time.
Okay, so we have got the payments, we know what goes in the liability bucket, we have got the timeline, we know how to calculate the term and when to reassess it. Now we need to talk about the most technical, math-heavy part of the equation.
The discount rate.
The discount rate, the invisible hand that turns future payments into a present-day liability.
Exactly.
For the listener who hasn't touched a financial calculator since college, let's just briefly explain why we even need a discount rate in the first place.
Sure, it's just the simple time value of money. If I owe you $100,000 10 years from now, that is not the same financial burden as owing you $100,000 today. Money today is simply worth more.
Right.
So to put a fair, accurate value on that future debt on today's balance sheet, we have to discount those future cash flows back to today's dollars using an interest rate.
And usually under Ind AS 116, this rate is either the rate implicit in the lease, which I understand is practically impossible to figure out because only the landlord knows their internal math.
Right. It's very rare a lessee has that information.
Or they use the incremental borrowing rate, the IBR.
Right. The IBR is basically the answer to the question. If I went to a bank today to borrow this exact amount of money with this specific asset as collateral for this specific term, what interest rate would the bank charge me?
Okay, so here is the dilemma. We just talked about Retailer M and TYK7. In year 3, they reassessed the lease term. They added years to the clock. When they do that new math to add the liability, do they use the old interest rate from year 1? Or do they use the current market interest rate in year 3?
This is a critical rule in the standard, the revised versus original rate rule, and the answer completely depends on why the cash flows changed in the first place.
Okay, lay out the rules for us. When do we use the revised rate? Meaning, when are we legally forced to update the interest rate to current market conditions?
You must use a revised discount rate if there is a change in the lease term, like our Retailer M example, or if there is a change in the assessment of a purchase option. Like you suddenly decide you are reasonably certain to buy the building at the end.
So for Retailer M,
Retailer M changed the lease term. They expanded it. So yes, they must update the discount rate. They have to go to the market in year 3 and ask, what is my borrowing rate today for this new extended period?
why though? Why not just stick to the old rate from year 1? It would be so much easier for the accounting team.
Because economically, by extending the term, you have essentially entered into a brand new financing arrangement. A 3-year loan and a 7-year loan are fundamentally different financial products with entirely different risk profiles.
That's true.
The interest rate should reflect the credit environment at the exact moment you recommit to the asset.
That makes sense logically, but man, it adds so much risk. If interest rates have skyrocketed since year 1, which, let's be honest, happens all the time, Retailer M is going to feel some serious pain. They are adding years to the lease and discounting them at a much higher rate.
Well, paradoxically, a higher discount rate actually lowers the present value liability number on day 1 of the change.
Oh, right, because you're dividing by a bigger number.
Exactly. But it severely increases the interest expense you have to book in the P&L every single year after that. So you get a smaller debt number today, but a much bigger hit to your earnings tomorrow.
Ouch. Okay, so when do we get to stick with the original discount rate? When do we get to safely ignore the macro market changes?
You stick to the original discount rate if the change in payments is due to one of 2 things. First, a change in expected amounts under residual value guarantee. Remember, illustration 20 with the trucks.
Yes, if my estimate of the truck's resale value changes.
Right. If you update that estimate, you change the cash flows, but you keep the original discount rate. And second, a change in future payments resulting from an index or a rate, like our CPI example from illustration 17.
Wait, unpack that second one. If my rent goes up because inflation went up, my actual cash payments are changing. I'm writing a bigger check. Why don't I update the discount rate to match the current market?
Because that specific change was already fully contemplated in the original deal you signed on day 1. The floating nature of the payment was part of the original pricing mechanism. You aren't changing the scope of the lease. You aren't adding time or space.
I see.
The contract is just operating exactly as
So
designed.
it's maintenance, not a renovation.
Exactly. You treat it as a pure continuation of the original liability. You update the future cash flows in your spreadsheet to reflect the new CPI, but you keep the original discount rate absolutely constant.
That is a subtle but incredibly important distinction. Change the scope, meaning time or asset, you get a new rate. Change the estimate or the index, you keep the old rate.
That is a golden rule of thumb for reassessments.
I want to walk through the actual math of a modification because the source material gives us a really specific example involving a year 6 adjustment. I think this really helps visualize the concept of adjusting the asset instead of hitting the P&L.
Right. This is a very common scenario.
Mm.
So let's look at this. We have a standard 10-year lease, but in use 6, that is the key date, the lessee and lessor agree to explicitly modify the lease contract.
Okay, so we are exactly at the beginning of year 6. There are 4 years remaining on the original deal. What happens?
They sit down and agree to new terms. Maybe the local real estate market has softened significantly. The rent goes down to $95,000 per year for the remaining 4 years.
Okay.
The source highlights that at the effective date of this modification, the start of year 6, the lessee has to totally remeasure the liability.
So they take those remaining 4 years?
They take the new payments, the $95,000. And critically, because this is a formal modification of terms, it is a renegotiation, they must use the new incremental borrowing rate. In the example provided, let's say it's 7%.
So they run the present value calculation, $95,000 over the remaining term discounted at 7%.
Right. And let's say that math comes out to a new liability of $389,500.
Okay. But on their books, right before this meeting, they had the old liability sitting there from the original amortization schedule.
Right. Let's say the old liability was carrying at $421,000.
So the liability has dropped. We owe less money now, about $31,500 less. Where does that difference go? Is it a profit? Do we pop champagne and declare a huge gain for the quarter?
Not yet. This is the beauty, or honestly the frustration, of the right of use model. You generally do not recognize a gain in the P&L for a modification like this. Instead, you adjust the right of use asset.
So I just reduce the value of the asset on my balance sheet.
Yes. You reduce the liability by $31,000 and you reduce the asset by $31,000. It is a pure balance sheet to balance sheet transaction.
Why, though? Why not take the win on the income statement?
Because the standard setter views the modification as just a fundamental adjustment to the cost of your right to use the asset. You effectively just negotiated a cheaper price for the remaining years, so the historical cost of your asset goes down. You will see the financial benefit in the future through lower depreciation expenses over the next 4 years, not as a massive one-time gain on lease modification today. It smooths the entire impact out.
That is super clear. It actively prevents companies from manufacturing fake earnings pops just by renegotiating a few leases before the quarter ends.
Exactly. It prevents earnings management.
But is there ever a time where it does hit the P&L immediately? Because I feel like in accounting, there is always an exception to the rule.
There is always an exception. And this leads us perfectly into Section 4, modification versus separate lease versus decrease in scope.
Let's distinguish these. First, when is a change actually just considered a completely new lease?
A modification is treated as a separate, entirely new contract if 2 distinct things happen. 1, the scope increases, so you get more physical space or more assets.
Okay.
And 2, the price increases by an amount commensurate with the standalone price.
So if I currently rent floor 1 and I decide to rent floor 2 and I pay the going market rate for floor 2.
That is just a new lease. You leave the old lease for floor 1 completely alone. You book a new separate lease schedule for floor 2. Simple. Don't touch the original math.
But what if it's not a separate contract? Like I get more space, but at a massive discount because I'm an existing tenant.
Then we are back in modification accounting territory. We usually do what we just discussed, remeasure the liability with a new rate and adjust the asset.
Okay.
However, there is the decrease in scope scenario.
This is the exception you mentioned.
Yes.
Yeah.
Imagine you lease 2 floors. In year 3, you modify the contract to give back 1 floor to the landlord. You have officially decreased the scope of the lease.
I physically lost part of the asset I was controlling.
Exactly. Because you lost part of the actual right of use, you must derecognize a proportional portion of the REU asset. You also reduce the liability, of course, because you don't have to pay rent for that floor anymore.
Okay, so I reduce both the asset and the liability. But do they reduce by the exact same amount?
Rarely. The math almost never lines up perfectly because of how depreciation and interest amortize differently over time. And that difference, the gap between how much the asset dropped and how much the liability dropped, that difference goes directly to the profit and loss statement as a gain or loss.
That makes total sense. It's exactly like selling a physical piece of equipment. If I owned a delivery truck and sold it, I'd calculate the gain or loss based on the book value versus the cash received.
Right.
Here I am essentially selling the right to use floor 2 back to the landlord.
Perfectly stated. That is the one major time in modification accounting where you hit the P&L immediately. For almost everything else, term extensions, rent changes, index adjustments, you just adjust the asset and move on.
This is dense stuff, but when you map it out, it really follows a strict logic. Step 1, define the payment. Is it unavoidable? Step 2, define the term. Are we reasonably certain? Step 3, pick the rate. Are we changing the scope? And step 4, handle the change. Adjust the asset unless we are physically shrinking the space.
That is the Ind AS 116 algorithm in a nutshell.
I want to circle back to something we touched on way earlier, the strategic element. We talked about how pure variable payments stay off the balance sheet, but let's look at the in-substance fixed again. The source material mentions disguised fixed payments.
Yes, it does.
It mentions payments that are structured as variable but have no genuine variability. Can you give me an example of that? A payment that actively tries to hide?
Sure. Imagine a company leases a massive solar power plant. The contract is written very cleverly. It says, you only pay $10,000 for every hour the sun shines.
Sounds incredibly variable. You're taking on meteorological risk.
But then the auditor looks at the meteorological data for that specific desert location. And you know for an absolute fact, based on 50 years of solid data, that the sun will shine for at least 2,000 hours a year.
Oh.
Or maybe the contract says, you pay rent only if the plant is physically capable of operating and the plant is literally brand new. The standard says if the event has no genuine possibility of not occurring, you have to treat it as fixed.
Wow.
You cannot use fake contrived variability to hide your debt.
That is a really high bar for auditors to prove, though, isn't it? Proving no genuine possibility.
It is difficult, but that's exactly why the standard is principles-based rather than just rules-based. It demands that you look at the economic substance. Another tricky example is resolving variability.
What's that?
Imagine a lease says, for the first year, rent is 5% of your total sales. After year 1, we look at what your average sales were, and the rent automatically becomes rigidly fixed at that exact dollar level for the remaining 9 years.
Ah, so it starts variable just to see how you do, and then it permanently locks in.
Right. Initially in year 1, it might be truly variable. But the exact moment that variability is resolved, at the end of year 1, it instantly becomes an in-substance fixed payment.
I see.
You then have to immediately remeasure the liability and put those remaining 9 years of newly fixed payments straight onto the balance sheet. You can't just say, oh, well, it started variable on day 1, so it stays off balance sheet forever.
It catches up with you.
It always catches up.
So we're coming up on time, and I really want to summarize the big takeaways for the learner listening to this. If you are a finance professional or just an investor trying to read a complex balance sheet, what are the massive red flags or the aha markers you should look for?
First, scrutinize the fixed costs. If you are reading a 10K and you see contracts with minimums, floors, or unavoidable tax pass-throughs, know that those are capitalizing into hard debt. If you are a CFO negotiating a lease, know that agreeing to a floor clause hurts your balance sheet leverage ratios much more than agreeing to a pure variable percentage clause.
Second, watch those lease term triggers. If your company makes a big strategic move, acquiring a rival company, renovating a flagship building, ask the question, did we just inadvertently trigger a lease reassessment? Did we just accidentally turn a small 3-year lease into a massive 10-year liability because of this one operational decision?
Exactly. Third, the discount rate matters immensely. In a rising interest rate environment, extending a lease is incredibly expensive, not just an actual cash out the door, but in reported liability, because you might be legally forced to update to a much higher current discount rate.
And finally, modifications. Every single time you tweak a contract, you have to run that flowchart we talked about. Is it a separate lease? Is it a scope decrease where I take a P&L hit? Or is it a standard modification where I just adjust the ROU asset?
Exactly. This standard forces companies to constantly rigorously monitor their operations. It forcefully connects the business side, what we actually do day to day, to the accounting side, how we report it in real time. You can't just sign a lease and file it in a drawer for 10 years anymore.
It really creates a dynamic balance sheet. It breathes. It expands and contracts with your actual business decisions.
That's a very poetic way to put it, but yes,
Yeah.
it perfectly reflects the reality that a lease is a living, ongoing commitment.
Okay, here is my final provocative thought for the listeners to mull over as we wrap up. We talked extensively about how Ind AS 116 aims for total transparency. It wants to show the right of use as an asset and the true obligation as a liability.
Hmm.
But if I'm a massive company, like a global cloud computing provider or a high-tech manufacturer, and I manage to structure my leases entirely on usage, I pay per server tick, I pay per jet engine hour, with absolutely zero minimum guarantees.
Right.
I could technically physically control an empire of assets worth billions and billions of dollars. I clearly have the right of use. But because of the pure variable rule, my balance sheet shows absolutely nothing. Zero lease liability, zero ROU asset.
That is mathematically correct.
So is that a massive loophole in the standard, or is that simply highly accurate reporting because I truly have no fixed legal obligation if I turn the machines off?
That is the big debate in accounting circles right now. The standard setters argue it is completely accurate because if you stop using the asset, you stop paying. There is no inescapable debt. But from an asset control perspective, it definitely makes the balance sheet look very asset light compared to a competitor who signed a traditional fixed rent deal for the exact same equipment.
It's incredibly smart structuring, and it is exactly why deeply understanding these rules, the true mechanics of 116, is a corporate superpower.
Absolutely it is.
We really encourage you to go dig out your own office lease tomorrow. Check for that floor clause. See if you're paying for real estate taxes and realize, yep, that's debt. Thanks for diving deep with us today.
Always a pleasure.
We'll catch you on the next one. Keep learning.